Welcome to Growth and Exit Strategies for Software and IT Companies, the flagship tech conference of the World Financial Symposiums. The GXS conference caters to tech founders and investors in tech M&A, covering topics like investments, growth strategies, buyouts, sales, divestitures, and mergers. Thank you for joining us. Let's begin.
Now, on to our last panel of the day, the Sellers Panel. Insider tips from CEOs who built and sold their own companies, led by Jaber Tannay, Senior Vice President at Corum Group. Jaber, take it away.
Well, thank you very much, everyone, actually. Thank you for being with us this morning or this afternoon. It is my pleasure to be here with Ari and with Erik. My name is Jaber Tannay. I'm a deal maker with Corum. I'm based in Paris. And with that, I'll stop talking about myself and actually I'll hand it to Ari for the introduction. Maybe we can do some introduction, Erik and Ari. If you can start. I'm indicating the left of my screen because on my screen you're on the left. So
okay, great, Jaber. Well, it's nice to see you, and thanks everybody for attending this. My name is Erik Kahn. I am the CEO of Bridgeline. I've founded several companies over the time and have had multiple exits. I've also acquired many companies, including one with Corum and Jaber out of Belgium in, I think it was 2021, if I remember right, which is great. My background is computer science. I've got a PhD in artificial intelligence, have generally been in the software industry, but I've also founded and run and then ultimately sold businesses in resort real estate as well. And currently, our business is focused on marketing technology. Bridgeline mission is to grow companies' online revenue by increasing the company's traffic to their online store, increasing the conversion of that traffic into buyers, and increasing the average order size for each one of those buyers.
Thank you very much, Ari, actually. And now up to you, Erik.
Yeah, thank you also for having me. I'm very hard to distinguish Ari and Erik. So I'm Erik, like the Northern Viking. In my first career, I've been a professional sportsman. So if you know canoeing, it's the paddling with the green and red gates. I've been a world champion there in my first career. Then I quit and became a serial entrepreneur. So I have not as much experience as Ari, but I also already built two companies, one in the e-commerce space. And then the last 8 years I spent with AI and chatbots before people were even talking about chatbots. And I have the pleasure to not have a PhD in artificial intelligence, but I quite studied some before starting this company. And my connection is to Jaber and to Corum that in 2022, I've exited my own software company. And then since then, enjoyed a very good sabbatical. And now I'm again a founder of a newly established business called the Culture Code Foundation. And we are advising companies to forge their high performance company culture and to build their unhackable USP by making people more engaged and more thriving in their business. And yeah, I am calling from Austria, so I have decided to move into nature and live a fully remote working life.
Thank you very much. Thank you, both of you. I would like to start this conversation by just taking the subject and maybe both of you, each one of you can take us through your an experience where you sold a firm and ideally in connection directly or indirectly with AI. So if you can take both of us, give us part of your experience, and then we don't hesitate actually to interact with each other and ask questions. I don't have to be the only one asking questions here. Maybe we can start with Ari.
Okay, very good. Well, my first company was a business called Fatwire. Fatwire was one of the first marketing technology businesses, in particular, one of the first web content management companies. We built Fatwire organically, didn't know anything about raising capital, frankly, from 96, when I was just finishing my doctorate at University of Chicago, to 2000. And at that point had reached about, if I remember right, $6 million in in revenue, and raised capital at that point, right before the dot-com bust. So we raised $10 million from Long Island-based venture capitalists, not California guys. And the good news for us was that we didn't know how to spend money because we'd been running the business off our credit cards, and all of a sudden we have $10 million. The market crashes. We bought a public company that had a $4 billion market cap for $7 million. It was a good time. We were lucky in timing, and continued to run that company until ultimately in 2008. So we did have patient venture capitalists, right? That's an 8-year timeline. Built it up to about $47 million in revenue, something like that, and ran a process, brought in a different CEO, the chief technology officer from Computer Associates, in fact, to help run that process, more seasoned public markets guy, and sold it to Oracle. The sale of the business was really straightforward. Obviously, Oracle, I don't know, they're probably buying multiple companies a week, right? Especially at that point in time. So they had their checklist, and I have to say it was zero drama, zero surprises. We did have EMC as a bidder as well, and we thought we were going to sell it to them, and Oracle upped their bid at the last moment. So definitely learned that bankers can bring the right people to the table, and you can be surprised at the last minute how much someone's actually willing to pay when you say no. So, sometimes it's helpful to say no in a negotiation, and then all of a sudden you get the real number.
Which probably also depends on your...
Sorry.
Just wanted to say saying no. Saying no also depends on your alternatives, which you have.
Definitely.
Yeah. Yeah, on my end, a very interesting ride. As I said, I started a chatbot company in 2015 before teaching my own about machine learning and understanding that there is an issue, because I've had my own customer service department at my former company, and it was quite a repetitive task. And it's quite funny if I'm now in ChatGPT times talk about chatbots, because everyone exactly knows what's been out there. And we started this other firm before there was even the word chatbot invented, and nobody even was working on that. But what I've learned is that being patient and just delivering a product to the market, we've had 2 years without any revenue. But then it started soaring, things got growing, and it became quite clear on a very strategic level that chatbots for customer service will be a feature of the big customer care systems like the Zendesks and the ticketing systems of these worlds where the agent is working in. So while discovering that, we realized that either we're going to raise a ton of money or we are going to go for an exit. And the discussion came up because we got knocks at the door from strategic buyers. They were just looking out, figuring out whether it's going to be a buy or build decision for them. And after mingling quite a long time around with just one single potential buyer, the question rose, do we want to go for a structured process and see what's out there in the market? And after spending 1.5 years with one single buyer, being nearly on a finish line, we took a step back, went for a structured process, and ultimately sold to someone else at a better price, which was, I think, on our side, quite a standard process. So we took the typical looking for an advisor, starting going out on the market, and took like a 9 months time frame from really starting the work on the documents, doing presentations, doing a long list, doing a short list, and then having management presentations, going to a term sheet. And I think it was a very clear process on our side, very structured and very organized. And ultimately, I wanted to comment on Ari talking about timing. For us, it was pretty intense, as usual, in the last 4 to 6 weeks in due diligence. And we have been selling 4 days after the Ukraine war started. So literally the whole deal team was working 24/7, and we didn't know what was happening over there because nobody watching the news. But why am I telling you? Because I think 6 weeks later, the deal would not have happened this way, because the funding markets crashed, valuations crashed in the software industry, which I was in. And we were quite lucky at this point in time to literally sign 4 days before that happened. 4 days after this war started, nobody knew about the implications yet. But timing for me is something that you can't control as an entrepreneur, but you just need to be patient on and ultimately keeping fingers crossed that nothing's happening that you cannot predict or cannot work on.
Yeah. So both of you are touching on the point that you need an investment banker to optimize the process. Although Erik did not specifically mention that, maybe you can correct me if I'm wrong. And both of you are pointing to the timing. So that the timing can make or break a deal, actually.
Yeah, I got 2 comments on timing and brokers. The one thing is, I don't have the authority to discuss with the strategic, like working with a broker helped me getting authority compared to, hey, this is a deal, this is going to happen, because otherwise it's quite hard as a CEO dealing directly with the buyer. So that helped me abstract a bit and creating dynamics. The second time with regards to timing, I think that's probably one of my biggest learning in this whole process, that I was so impatient, and that there is a certain timing because you were talking to a few potential buyers before and they will be addressed later in the process, and keeping calm and waiting until the right time comes, because by nature I'm a patient as a CEO of running a company. I think that was quite a learning that in this process it's about accumulating offers and negotiation tense, so that you have multiple people on the table within weeks. And I think that timing is something that one needs to have experience with, how long these processes take. And I didn't have that, so I was happy to have someone on my side supporting me.
Yeah, when you're selling a business, it's very important to have multiple bids. And unless you have enough time to go out and build a big network and get a broad marketing campaign yourself, you're going to end up not having the right people at the table, or not having enough people at the table to do a proper negotiation. In addition to that, unless you've seen a lot of deals, it's hard to imagine how to really negotiate and bring new concepts, especially if you're selling a private company where there's going to be potentially a complicated earnout or some other structures to the business that is not just a clean cash deal, like if you're selling a public company would be. And the reality is that when you have a banker that does it for a living and is doing multiple deals per year, I mean, entrepreneurs just never going to have that much experience because they're not running around doing that many deals and meeting that many strategic buyers and PE buyers and so on and so forth to bring the different types of bidders to the table. So it's almost, I don't know if this is the right term, but it's almost a little bit arrogant and unrealistic to think that you have both of those skill sets and both of those sets of connections of being able to build a company that is worthy of a reasonable exit and being able to bring the right people to the table and negotiate properly.
One thing that I learned in this regard is that the ultimate company buying us, I didn't know before, which is a very interesting, I mean, the process took quite some time and we kind of know them, but I didn't know the management specifically. So that was something that I realized, that there is a bigger network out there, and while we are preparing the long list, I learned about potential buyers that ultimately had quite some interest that I would not have brought to the table on my own, because that's why there are experts on the market that can help. Like, I'm also not filing my company's taxes on my own. There is people that can do so better and more efficiently.
It's really interesting, right? You're either selling to someone you know or someone you don't know. If it's someone you don't know, it's helpful to have a banker who can bring that person to the table because you didn't know them. And if it's someone you do know, you kind of need a middleman to help in the negotiation, because it's hard to, to do that with somebody that you know.
And you want to be friend at the end of the negotiation. That's also very important, actually.
It is. I wrote an article in Forbes recently. It's a 3-part article on M&A. The third one's coming out. And one of the points, for a spoiler alert, is that this is more on the buy side, but stay friendly with the seller, because you don't know what you're going to need from them 2 months after the deal's done, because they know where the skeletons are buried. There's always a skeleton.
Yeah. And just jumping on this one, I can tell you that, we were selling a company in very good faith and negotiating. Everything was great and we were looking to a bright future. And then funding markets dried up, which means 6 weeks after the deal, that was a very strategic decision to be taken, that we're not increasing the resources, we're decreasing resources, which just building on Ari's comment, you never know what's going to happen down the line. So I fully buy into that.
I would like to bring AI into the conversation and just check whether anything was different for you, Erik or Ari, in the fact that you were selling an AI firm, or was it business as usual? Like, do you think it would have been the same with a traditional firm, or does AI add something actually? Ari, maybe.
Well, there's the market today, and there's the market even 4 or 5 years ago with respect to AI. In fact, I was at a Gartner conference 2 weeks ago. A bunch of VCs were on a panel, and they were talking about how there's AI valuations and everything else. And you're doubling your multiple, maybe tripling your multiple if there's AI involved. So in today's market, having a strong AI story is going to bring different people to the table, maybe companies that are looking just for some news and willing to pay a high multiple for something that has AI involved in it, and more sophisticated buyers who actually understand AI, know where their gaps are, and whether you can fill them or not. And just a few years ago, it was not such a decisive valuation impact because AI didn't deliver the kind of value that it does suddenly. And this isn't going away. This is growing upon itself, and it's going to grow exponentially for a long time. The advances in large language models and the maturity of the APIs that allow you to use them to solve real business models, real business problems, is happened overnight and has leveled the playing field for large and small businesses, where any company can quickly plug into an open AI model or one of its many competitors, and if they understand a business problem, leverage that language model to solve that problem without an army of engineers and years of R&D. So if you're considering selling a process or running a process, you should take a look at how you can solve a real-world business model in a relatively short period of time for your customers with these large language models.
One thing that came to my mind when you asked the question, Jaber, was how do you convey what you solve and why your algorithm is better than others? So I fully agree that AI skyrocketed valuations in general, but in any case, for me, it was very hard because you got a management presentation with 10 to 15 slides. You got 2 slides for the product and maybe 1 slide for the algorithm. So how do you condense why your algorithm is better than the 3 competitors out there? And not only that it's better, but saying why on 1 slide was for me the most crucial thing to get attention, because the rest was quite obvious. We got awesome net dollar retention, we got good growth rates, we got good KPIs. So that was very clear, but explaining to the potential acquirer why we are different, and we were different, and why our approach is better than others. Because in the M&A teams, which I see as the biggest challenge, there are typically non-tech people that need to understand from a presentation perspective that this is intriguing, and then ask the tech people to check it. And I think this problem has increased with large language models because it's even harder to look into them. Our algorithm back then was not a large language model. It was more explainable. And these days, explaining what it really does in a precise manner is for me the biggest challenge, because you got 3 minutes for that one.
Yeah. I would agree actually with Erik. I advised several recent sales in AI systems. I'm referencing to AI machine learning, not chat based. And the main issue was to explain that my client actually was really delivering the value we were claiming to deliver. So we had a lot of question marks and suspicions and misunderstanding from the buy side. And that made it more interesting in value, as you just mentioned, but also more challenging in terms of the explanation effort that was required. Would you would you agree to that? Actually, you're sitting in. I see you sitting in both sides, actually, as a buyer and as a seller at the same time. Actually, in your recent experience.
So from my perspective,
I was referring to Ari actually. So
okay, great. Well, I'll take a shot at that. So, at the end of the day, technologies is a means to an end. And you need to have a clear value proposition, demonstrate that you're able to execute upon that value proposition. And that's a business discussion. And that's what the M&A team that Erik mentioned first and foremost is going to look at. Then you're going to have a due diligence team that's going to confirm whether you do what you say you can do and it's technically feasible and so forth. But those two slides, as Erik described, are critical, that they are crystal clear as to the TAM, how many people have this problem, your total addressable market, the value proposition, and that you've got demonstrable sales and customer retention and so forth that show that you can actually market this capability. All right, so that's what your initial deck needs to do. Now you've got a due diligence team that's going to peel back and take a look and see whether this technology actually delivers upon that commitment. And one of the challenges that you'll run into is that who is on that team on both sides? They could get caught in the weeds. They could end up having an argument back and forth about their favorite technologies and the way things should be versus how they are and so on and so forth. So you really need to be able to manage that, because often those teams are not deal guys, M&A deal guys. They're often not salespeople, and they're often not business people. They're experts, brilliant experts in technology, different skill set. So you need to be able to manage that. And that also gets into a whole other problem of leaks and so on and so forth that we could talk about later. But clear articulation of the value proposition, the size of the market, proof that you're actually solving it, and then careful management of that team is critical, or else deals can blow up for the wrong reasons.
Very well said, Ari. I would like to add the point of a spurious relationship, because you got something going on and you got good KPIs. So how do you make sure that the algorithm is directly causal to the good business results and not only logically correlated, but like every product is based on some product and some AI. It's not only always AI. So the question is, what's driving the customer value? And we had the issues. We had quite a big software, and there were tons of integrations and user interface here, user interface there. Here was a chat widget, and here was a chatbot, and it had great features, and we could automate processes. And I need to make clear that the root cause in the middle of everything is the algorithm, so that the technology can be scaled and it's not the software product. So that is a typical question of correlation and causation, which for me was the bridge that I learned it afterwards. I'm really honest, I didn't know back then that I needed to make this point clear. But to the end, I learned that if I could do it again, I would explain that my AI is directly causal to the business results of my clients, and not only part of the product, because the product is typically bigger than just an algorithm.
You know, that's really interesting. And people have long spoken about technical moats as well. And that comes into the same thing. So is it causal, and can somebody else easily do it? And if you can provide a succinct explanation of that causality and moat to the deal team, and if you're able to even have that, maybe it's not a full slide, but as a portion of the slide, and be able to just get that concept well understood by the deal team, then the engineers, who may never really be able to fully explain that and prove it out, you can avoid them potentially delaying or blowing up a deal by getting caught in the weeds on that, where it's like, okay, no, these guys have the causality. It's hard to prove, and you can't fully prove it, but you can show enough evidence, or at least that you understand that that is a critical requirement for the acquirer to have them respect it and check the box and move on.
Maybe we can move on to the next question, which is, what would you have done differently? Now, both of you have, with hindsight, what you would have approached differently with the benefit of your current experience?
Well, I, as a technologist, have often found myself taking money from sales and marketing and giving it to the engineers and thinking that that's long-term thinking and so on and so forth. And it is. But at the end of the day, especially 2 or 3 years pre-exit, you have to make those sales move. And one of the key things is to know that you've got consistent lead gen, places where you know that your customer acquisition costs are efficient, and then you can dump money towards that so that you can boost that growth. So understanding the marketing campaigns that work, investing heavily in those pre-deal, and showing growth is something that, for me, when I reflect on my history, is something I need to do.
In hindsight, on my end, I wouldn't do quite a lot different in how I was running and building the company, because that was working well. But the core skill is seeing into the future, and the whole strategic market timing. There's a window of opportunity for being acqui-hired, being hired for revenue and synergies, or being a financial acquisition, and being able to, like, I think I was seeing it 1.5 to 2 years before it happened at my company. So I was planning not to raise a big funding. I was planning to consolidate numbers. I was doing housekeeping before there was even due diligence coming. So I was planning it very strategically. But building on what Ari said, I should have taken more time, more resources to say, okay, there is an M&A process happen. How can I strategically set up the organization? Because it takes 9 to 12 months to change something, to, for example, make the KPIs better, to have either better retention KPIs or have better sales KPIs or better algorithm KPIs, depending on what I need, what my anticipation is for why a potential buyer might be interested. Meaning, I should have consulted earlier experts to talk about, like, these are things that you only know afterwards, and it's specific to a certain business. Hey, why is your business going to be bought by whom, for what reason? And getting with an advisor earlier and having these discussions. And I would have taken the time, 2 years pre-exit, not only 1 year pre-exit, I think would have made a better outcome strategically.
That's a really great point. You don't need to engage your banker because you're going to start a process the next day. You can engage your banker 2-3 years ahead of time. Start understanding who the targets are, what the KPIs and SaaS metrics and other things are, and it'll help you run a better business. I mean, at the end of the day, better businesses sell for a higher multiple, and it'll also help you build a relationship with your banker. Maybe it's the wrong guy, and it'd be better to find that out before you start a process. Maybe it's the right guy, but you need to learn something, or he needs to learn something. So I think that's a really great point. You don't have to wait until the day before you're going to launch that process to start that engagement.
But that also means, Ari, that one needs to have the capabilities. And I'm currently talking to quite some CEOs, whether they believe in something like culture being so fundamentally relevant, and you need to plan years ahead to build your cultural USP. And I am seeing that 80% of CEOs are very under stress and overworked, and don't take the 10 to 20% of time. I call that mind time or free time, where you need to have this creative mind active, not the operational execution mind, but the how do I envision the market, because nobody really has it, and how do I take the time for these visionary thinking. And I think that boils down to, you need to be able to build an organization that can run on its own, which doesn't require 120% of you, but only the 80% of your work time, because you can take time off the business, which means being a better structured, organized CEO helps having a better exit, because you have the time to do what you just said, mingling with an advisor or people strongly before.
That's a great point, and difficult to do for sure. I mean, most people that are CEOs are that way because they like to get into the details and so forth. And you do have to be able to step back. And you also need to think hard. And sometimes you don't have this luxury, but who are your investors, who is on your board of directors, because if you can't have the right relationship with them and have everybody going in the same direction, you end up with either a completely dysfunctional board and set of investors, which I think happens way more often than the alternative, or one where there's infighting and potentially everyone just throws up their hands and runs a process because they can't see everyone on the same page. So that's very difficult as well, and that may take years. So if you're in your first round of financing or an early round of financing, have a couple dinners with your with your prospective investors, get to know them a little bit, find out what they're like when stress is, find out when their LPs expect an exit and so forth, so that you don't end up with those problems.
I like very much your idea, actually, too, that preparation needs to start much earlier than 6 months before the deal, or a few months before the deal has to start. And by the way, Ari, your suggestion of hiring the banker 3 years earlier sounds like music to my ears. So, but let's now put forward a little bit and start the due diligence. Or so, any suggestion that you would have done differently? Anything that you would have liked to have done before when you were within the deal, actually?
I think I can share one of my biggest learnings with regards to due diligence. Like in my former company, the company before the AI chatbot company, we sold it. The deal crashed 48 hours before the deal. So we were fully done negotiation and due diligence. And what I've learned is that due diligence takes so much time and effort that you can effectively do the due diligence 90% before the due diligence starts. So just ask your favorite M&A lawyer or your advisor on, give me a checklist, and you're going to get the big shebang checklist and just execute the full checklist like it would be a true due diligence. And once due diligence starts, you can pull it off and have 80% done already, which we were doing. Because I knew that process would be starting, and there were some weeks off, so we were doing due diligence on our side. And only 1 to 1.5 weeks after due diligence starts, we were delivering all data, meaning we put the buyer under stress because they were thinking we were so fast. And that really helped me get a breathing room for everything else that was going on in the company.
Yeah. Having a clean data room and getting started early. A lot of times, the information, your buyers are going to respect confidentiality, and you don't have to wait until you've already got an LOI and you're far down the road to start sharing information. So it is fine to share stuff earlier. But when you have, I don't want to keep on going back to this, but when you have a banker engaged much earlier, you can start developing that data room years before you actually use it. And it becomes really easy to keep it up to speed. The hard part is creating it in the first place. And then having your VP of finance or CFO or whatever maintain records, and having your engineering team keep source code in escrow or something like that so that it's easily accessible is just an incremental effort going forward, because there's already stress when you're considering selling it. Am I doing the right thing? Why am I selling this company? Tomorrow it's going to be so much, and so on and so forth. Why create all that other stress with the administrative effort of putting together a deal room when it could have been done way earlier?
Yeah. Maybe one really practical advice. I put myself into the shoes of the buyer, and we made really nice documents just because that was a quality and growth. So we had someone responsible for the content, and then we had a 4 eyes principle on every spreadsheet had exactly the same logo, exactly the same colors, exactly the same formatting. And there were quite some spreadsheets, from a list of people to a KPI document to Word documents with text questions. And we were putting quite some effort into making things look consistent, because I'm expecting this from my people. So I was assuming that this made a good impression on the buyer.
Yeah, I think that's great, right? And it also creates certain camaraderie with the buyer. And quite frankly, when you have inconsistent looking documents, it chews up brain cycles just figuring out where to look, because things are all formatted different. You respectfully save that much effort from the other side that's got to interpret pretty complicated data.
Yeah. One thing that I also learned in our process, and that was also through the help of our advisor, typically every company has some challenging things which they know are probably relevant to the buyer, maybe not. Like everyone has like these, call it dead bodies. I don't know if this is right translated. Everyone has something in the basement. Typically, it just exists. And now looking in hindsight, what we were advised to just put it on the table early on in the process when stakes were not so high yet, because then being open, say, this is what we have, helped us. Like, when emotions run strong, when you really negotiate about price and millions of euros up and down, you don't want to have any negative signals in that process. So taking the negative signals out, knowing that they will exist, is some planning. I think that was a pretty smart move on our end. I mean, there were no big issues, but of course, maybe your third biggest client will quit or has quit already, and you don't want to tell this to the buyer, but do it upfront, do it precise, and proactively communicate, yes, this is our third largest client. Yes, he quit. This is what we're doing. And by the way, we are growing this quarter anyways.
Erik, I think that's the best advice that anyone can share, right? It's going to come up. And if it comes up in the heat of negotiations, then that is not good. Bring it out early. And if it's a problem, then great. You've saved everybody a bunch of time and that buyer leaves and you talk to someone. That is great advice.
Sounds very, very good. Is there anything we wouldn't have touched upon and that you would like to bring into this conversation before we finish?
Well, one other detail is that, especially when selling a private company, a lot of times you're going to have an earnout. And keep it simple. 2 years down the road, interpreting some crazy formula. What I like to do is to actually have an Excel spreadsheet that everybody agrees calculates the earnout value. Save it. I mean, if you need to, put it in escrow or whatever, but you probably just having it emailed back and forth with a good timestamp on it would suffice for everybody. Obviously, the earnout has to be defined in legalese in the definitive agreement, but that spreadsheet has been very helpful to me in the past.
Oh yes,
that's great advice. Actually, that's great advice. I can remember conversations about a 60 pages. Contract 2 years down the line, and everyone was asking what this sentence means. It's always better when it's very simple. This is excellent advice, actually, Erik. And sorry, I interrupted you, Erik. You were going to say something. I
wanted to say the same things. Our lawyer said no spreadsheets. They're just exemplary. But the point is, nobody wants to read the contract. The business people take a year later, they take their earnout, they fill the numbers, and they agree on a spreadsheet because they've seen a spreadsheet before. And it's so hard from a contract to create a spreadsheet. But if you have a spreadsheet showing, and the business people on the deal agreed on the spreadsheet and checked all the formulas and checked the definitions, this really helps. Some other advice that I've seen is planning the exhaustion level of oneself. So for me, the last 8 weeks were just so exhausting. And I was telling to my wife, and we got 3 kids, I said, I am off any family life. I've been working so much and working and sleeping, and I was fighting against operative business and emails from anyone, from due diligence to negotiations. And knowing that there will be a strong exhaustion once there is a signing or a closing, but then things don't end, because then you typically have an earnout, which I don't like earnouts because they're typically not interest aligning between the buyer and the seller. But very often you feel, okay, now I'm done, and you really need a few weeks of pause, but you don't get them, which means you're then in the earnout, which probably is a significant portion of the valuation that you need to power through, which leads to structural exhaustion. And I think knowing about this and planning it, and also communicating to the buyer, I will take 1 or 2 weeks off post-exit, and then I'm going to be with their full steam. You will have discussions which ends to, okay, you're going to do half what you just said, but you need to take a few days off, which I gladly did. And I was happy that me with my wife and our kids, we just, it was a tough time before.
One other thing that as a seller that I found is that, so post-deal, 2 things suddenly happen. You've got money and you've got time. and they both disappear pretty quickly.
Yeah, I think I came to the realization after being really unemployed, meaning, it depends on whether you are on board for multiple years or there's going to be agreement where you leave. But at a certain point in time, you will leave. And I think at that point in time, I realized that being not a CEO after being 15 years a CEO of multiple companies and taking this time off, recharging, I think then you realize what has happened before, because before you're still responsible for the earnout for your investors, for the buyer that has bought you, and for your people.
This has been extremely rich, actually, of very interesting advice. Thank you very much, both of you. We still have time if you have additional comments. So please feel free to jump in.
I have one. Don't at all spend any of the money, just not change your way of living. And don't do as much venture investments as you like. Ask a few people that have been there before. Ask a professional wealth manager, and especially do not put all of your money into illiquid assets, because illiquidity, are illiquid by definition. So wealth and liquidity is not the same thing.
So how do you feel about restarting a new firm? Would you only start a public firm to have liquid stock?
That's an interesting one. I founded a company again because it's my profession. And as I said earlier, I do think there is a big shift in these days societies where people need a strong, empowered work culture, where companies are more successful with people that are very smart knowledge workers. And I decided to not take external investors, but to fund the company myself, at least for now, to have a high equity stake, and just to run the business on my own terms as much as I can.
After I sold my first business, I was very fast to launch another company, and I didn't take any time, and I probably should have. I don't know why I felt so eager to get something going, but after I sold that one, it was a little bit different, and took a breath and really thought hard about what I wanted to do, and that made a big impact. I think that's a great point. Everyone needs to understand that illiquidity, private companies, real estate, there's a lot of very exciting investments that are illiquid, and that is not the same thing as having a liquid investment. I like to invest in myself. I think that a lot of entrepreneurs probably do. Don't spend it all. Don't tie it all up in some illiquid thing. Make sure you've got cushion, you've got family, children, other responsibilities. But it's not the end of when you sell a business. It's a beginning, but make sure you have the right beginning.
To our audience, we appreciate your participation today. Visit wfs.com for more information on events coming up. If you'd like to get in touch with the WFS team, speakers, or the Corum Group, email us at info@wfs.com.
World Financial Symposiums, the education center for tech leaders.